All right, so you actually want to own a crop farm. Buy some farmland, plant seeds, harvest once a year, sell the crop, watch the checks come in. It's the classic row crop operation, the same kind of farming business that's fed the idea of the American family farm for generations. You've probably seen the movie version of this a dozen times. A pickup truck bouncing down a dirt road, golden light over the fields, a combine cutting the last row as the sun goes down. Everyone eats, so demand is rarely the real question. It sounds simple. Maybe the most straightforward business you could start, except it's not simple. Not even close. In this business, you don't set the price of anything you buy, and you don't set the price of anything you sell. You're a price taker on both ends, in a market where a single county's yield report can move a national commodity price against you before you've even finished harvest. The operators who understand that before they sign for their first equipment loan are playing a completely different game than the ones who find out during their first bad year. So before you pick a crop, before you lease your first acre, you need to answer one question that has almost nothing to do with farming itself and everything to do with why this business quietly destroys people who look perfectly capable on paper. How much fixed cost can you carry through one genuinely bad season before the bank decides you don't get a second one? Here's the thing that surprises most people. That question has a completely different answer depending on whether you're farming 500 acres or 5,000. So we're going to walk through this business at three real scales: the starter operation, the established operator, and the scaled operation. And by the end, you'll see exactly why the math changes so much between them. By the end of this video, you'll understand exactly what it costs to buy and operate this type of business, whether it's genuinely profitable, and whether it's something you'd want to consider for yourself. This is actually costs. Every week we break down what it costs to own the businesses everyone talks about, but nobody explains. Subscribe, because you don't want to miss what's coming in this one. Not all crop farms are the same business. Before we get into the numbers, we need to talk about what crop farm really means, because it's one of those terms that gets used to describe at least 7 genuinely different businesses that happen to involve a tractor and a growing season. A row crop farm, corn and soybeans concentrated across Iowa, Illinois, and the rest of the Midwest Corn Belt, is what most people picture, and it's what this video focuses on, because it's the largest, most common version of this business by acreage in America. A wheat farm, concentrated across the drier Great Plains, runs on far less irrigation and fertilizer input than corn, which changes the entire cost structure, but it also produces less revenue per acre, which means wheat operations typically need more total acreage to support a family than a corn and soybean operation does. A cotton farm, mostly in the South and the Mississippi Delta, adds an entirely separate layer of cost and complexity most row crop farmers never touch. Ginning fees, cotton-specific harvest equipment that can run over $1 million for a single stripper, and a global textile market that behaves nothing like the corn market. A rice farm, concentrated in Arkansas and California's Central Valley, requires flooding entire fields for months at a time, which means the infrastructure bill is dominated by irrigation and levee systems instead of drainage. Precision land leveling equipment alone, needed to hold water evenly across a field, can add hundreds of thousands of dollars most row crop farmers never have to spend, a completely different capital problem than a Midwest operation ever faces. A specialty or produce farm, fresh vegetables sold to grocery chains, restaurants, or farmers markets, trades the commodity price problem for a perishability problem. Unlike corn sitting in a bin, a truckload of unsold lettuce is worthless in days, and the labor cost per acre runs many times higher than row crops because most of it still has to be picked by hand. An organic or identity-preserved grain farm plants the same corn and soybeans as everyone else, but forgoes genetically modified seed and synthetic inputs in exchange for a genuine price premium, often 20 to 50% above conventional grain, at the cost of higher labor, lower yields, and a multi-year certification process. Most operators spend 3 full seasons farming organically before they're allowed to sell a single bushel at the organic price, absorbing conventional level costs against conventional level revenue the whole time. And a contract seed production farm grows seed corn or seed soybeans under contract directly for a company like Corteva or Bayer, at a locked price agreed before planting, trading away the upside of a strong commodity market in exchange for insulation from a weak one, under strict quality and isolation distance requirements the buyer inspects before every payment. These are not small variations on the same business. They share a growing season and a tractor, but the capital required, the risk profile, and the buyer on the other end of the sale are different enough that a wheat operator and a rice operator would barely recognize each other's balance sheets. This video is going to focus on the row crop farm, corn and soybeans, because it's the largest and most representative version of this business, and because the economics we're about to walk through explain most of what drives every other type as well. Let's start with what it costs to put a single seed in the ground. The starter operation, 500 acres. The starter operation is close to the minimum scale at which someone can call this a real business rather than a hobby. 500 acres of corn and soybeans. Almost nobody at this scale owns their ground outright. Buying 500 acres at the national cropland average of roughly $5,800 an acre would run close to $3 million. More capital than most first-generation farmers have access to. So the starter operation rents. Cash rent on decent row crop ground runs $200 to $350 an acre a year. Call it $270 on average, which puts the annual rent bill at around $135,000, due whether the harvest is good or bad. The USDA's Farm Service Agency does offer beginning farmer loan programs specifically aimed at operators at this scale, with direct ownership loans available up to $600,000 at below market rates. It's a genuine, useful program, but $600,000 doesn't come close to covering even a modest land purchase at current prices, which is exactly why it functions as a bridge into renting and gradual ownership rather than a path to buying 500 acres outright on day one. Most starter operations spend their first decade renting the bulk of their acreage while slowly buying small parcels as the opportunity and the capital line up. Often from a retiring neighbor, often at a price negotiated privately rather than through a public listing. Here's where the starter operation runs into the first structural problem of this business. Fixed costs don't scale down. A modern combine costs $400,000 to $850,000, whether you're running 500 acres or 5,000. On 500 acres, that's an impossible number to justify. The depreciation alone would run over $1,000 an acre. So most operators at this scale don't buy a combine at all. They hire a custom harvest crew, which runs $25 to $40 an acre, and they buy older, used equipment for the rest, a used tractor and planter, maybe $150,000 to $250,000 total instead of the million plus a full new equipment set would cost. The trade-off is real. A custom crew means someone else's schedule decides when your corn comes out of the field, and if their equipment is 2 counties over, when a storm front is closing in, you wait. Many starter operations solve the equipment problem a different way. Shared ownership. 2 or 3 farmers this size will go in together on a single planter or sprayer, splitting the purchase price and the depreciation, then coordinating on whose fields get planted first each spring. A real, if delicate, arrangement that only works between operators who trust each other enough to hand over the keys to a $250,000 machine and mean it. Run the numbers. At real 2025 crop prices, 250 acres of corn at 190 bushels and $4.20 a bushel brings in about $200,000. 250 acres of soybeans at 55 bushels and $10.35 a bushel adds another $142,000. Total revenue around $340,000. Against that, cash operating costs at roughly $750 an acre run close to $375,000, plus the $135,000 in rent, plus $15,000 to $20,000 in custom harvest fees. Total costs somewhere around $525,000 to $530,000. On paper, the starter operation loses close to $185,000 in a normal year, before you've even paid yourself anything for the hours you put in. This is precisely why the median farm household in America earns more of its income from a job in town than from the farm itself. At this scale, the farming operation usually isn't the primary income. It's a second full-time job layered on top of one, run because the land is already there, inherited or slowly being paid down, and because 500 acres today is often the seed of something larger a decade from now. The established operator, 2,000 acres. Now scale up to 2,000 acres, the point at which this genuinely becomes a full-time, standalone business. The established operator. At the Illinois Corn Belt average of $9,850 an acre, 2,000 acres of owned cropland runs close to $20 million. That's exactly why most established operators own only a portion of their acreage outright and rent the rest, blending ownership and lease the way most real operations work. And it's also where the financing structure of this business gets genuinely complicated. Land is typically financed with a long-term mortgage running 15 to 30 years. Equipment sits on separate term loans, 3 to 7 years, tied to the specific machine as collateral. And the day-to-day cost of growing the crop, seed, fertilizer, fuel, before any of it has been sold, runs on a completely separate operating line of credit, drawn down through the spring and summer, and repaid in a lump sum once the harvest is sold in the fall. 3 different lenders, 3 different terms, 3 different sets of covenants, all attached to the same 12 months. At this scale, owning a combine stops being optional and starts being close to mandatory. The timing risk of relying on a custom crew across 2,000 acres is too high. A full equipment set, combine included, runs $1.5 to $3 million, most of it financed. And here's the number that explains this whole business better than any other. That combine works 3 to 4 weeks a year at harvest and sits in a shed depreciating the other 48. The established operator is a price taker in both directions: seed, fertilizer, and diesel priced on global input markets, corn and soybeans priced on the Chicago Board of Trade. In 2022, when the war in Ukraine disrupted global fertilizer supply, nitrogen prices, already elevated from the year before, spiked further, with urea peaking near $925 a ton that April, up from roughly $550 just before the invasion. The fertilizer bill on an operation this size jumped by well over $100,000 in a single planting season, an increase that wiped out the year's margin for anyone who hadn't already locked in their input costs before the spike hit. A single geopolitical event on the other side of the planet, showing up as a real number on a real invoice in Iowa 6 weeks later. Run a normal year at real 2025 crop prices. Cash operating costs: seed, fertilizer, chemicals, insurance, fuel, drying, labor. Run $1.1 to $1.3 million across the full 2,000 acres. Revenue, at the same corn and soybean numbers as before, lands around $1.4 million. Even in a decent year, the margin is somewhere between $60,000 and $200,000, against $22 million or more in total capital deployed. That's a return on total capital of well under 1%. Run that same operation through a rough year instead, because this is the part the good year math never shows you. A dry August cuts yield by 15%, corn drops to $3.80 a bushel instead of $4.20, and diesel and fertilizer costs stay right where they were. They don't care what the weather did. Revenue falls to somewhere around $1.1 million, while operating costs barely move at all. Where a decent year left a thin but positive margin, an ordinary bad year, not a drought, not a disaster, just an unlucky August and a soft market, pushes the established operator into a loss of $100,000 or more, on top of debt service that was committed months before the crop ever went in the ground. Now here's the re-hook, because this genuinely isn't just a cost and risk story. Even with margins this thin on paper, the established operator's business can be far more durable than that single number suggests. The USDA sends $10 to $15 billion a year in direct payments to crop farmers through programs like price loss coverage and agriculture risk coverage, and it subsidizes a majority of every farmer's crop insurance premium. On this operation, those programs can add well over $100,000 in a weak price year. Not a bonus, but what keeps the business solvent. And underneath everything, the land itself has appreciated at roughly 4 to 6% a year on average over the last 2 decades, building real equity that has nothing to do with what corn traded at in any given October. This is where operating leverage becomes the whole story. Almost every dollar of cost, the land payment, the combine loan, the rent, is committed before you know what the harvest will yield or sell for. In a good year, once fixed costs are covered, every extra bushel is close to pure margin. In a bad year, those same fixed costs don't shrink. They're paid out of a smaller harvest sold at a lower price, and the loss compounds faster than the shortfall alone would suggest. This is exactly the trap that catches capable, experienced operators again and again, and it tends to play out the same way almost every time. Picture an operator coming off 2 genuinely strong years. Corn prices elevated, yields good, the equipment loan paid down faster than expected. A lender offers to finance another block of acres at a rate that looks completely reasonable given how the last 2 seasons went. The operator takes it. Nothing goes wrong the first season on the new ground. Nothing goes wrong the second. Then a wet spring pushes planting 3 weeks late, a dry August cuts yield by a third, and the same week the new land payment comes due, the elevator is paying less than what it costs to grow this year's crop. The debt taken on when everything was working now has to be serviced by a weak harvest sold into a soft market at exactly the same moment. Agricultural lenders see this pattern often enough that it has its own name in farm finance, expansion-sized to the best year instead of the worst one. It's consistently one of the most common reasons a genuinely experienced operator loses ground they've farmed for decades, not bad farming, but debt that assumed the good years would keep showing up on schedule. Nobody driving past that operation in year one would have seen anything but the picture we opened with. The truck, the fields, the machinery working exactly like it's supposed to. The debt was never visible from the road. The scaled operation, 5,000 acres. Push to 5,000 acres and beyond, and you're in a genuinely different business. The scaled operation, run with hired management, a full equipment fleet, and enough acreage that the fixed costs which nearly sank the starter operation now barely register per acre. At national average land values, 5,000 acres runs close to $29 million. At prime Illinois ground, closer to $49 million. In a representative year, half the acreage in corn, half in soybeans. At the yields and prices we've been using throughout, total revenue lands around $3.4 million against non-land operating costs and rent that leave roughly $250,000 in profit. A margin just over 7% on paper, a genuinely respectable outcome. Change one variable. Drop realized crop prices by just 10% while yields stay exactly the same. No drought, no disaster, just a softer market. Revenue falls by well over $300,000. Rent doesn't reset. The equipment loans don't pause. That $250,000 profit becomes a loss of close to $90,000 on a business that looked 12 months earlier like the safest, most diversified tier of the three. This is where the scaled operation's real advantages show up, not in avoiding volatility, but in surviving it. Grain storage lets an operator hold the harvest and sell weeks or months after everyone else has dumped grain on the local elevator at the worst possible price of the year, capturing a better basis once the glut clears. A concrete example of what that's worth. If the harvest week price runs 20 cents a bushel below what the same grain fetches 8 weeks later, once the delivery rush has cleared, that gap alone is worth roughly $200,000 across 1,000,000 bushels. Real money a starter or established operator without bin space simply never sees, because they don't have anywhere to put the grain except straight onto the truck the day it comes out of the field. Spare equipment and labor capacity can be sold as custom planting, spraying, or harvesting work for neighboring farms, spreading the cost of that idle combine across more acres than the operators own. Scale itself creates purchasing leverage on inputs that a 500-acre starter operation simply doesn't have. And increasingly, scale is what makes modern precision agriculture technology worth the investment in the first place. As of 2023, roughly 70% of large-scale crop farms used automatic steering guidance, and 68% used yield mapping and soil mapping systems because a technology that saves $5 an acre is worth $25,000 a year on a 5,000-acre operation and barely worth installing on 500. None of it makes a bad year painless, it makes a bad year survivable, which, at this scale, with millions of dollars of debt riding on it, is the entire game, where the real wealth sits. Look across all three tiers, and one pattern holds regardless of scale. The crop itself rarely produces a return that would justify the capital tied up in the land underneath it. What holds this whole business together at 500 acres or 5,000 is the combination of government support smoothing the worst years, storage and diversification, giving operators some control over when they sell, rather than being forced to sell on the worst day of the year, and the land itself compounding in value year after year, independent of whether any single season's crop made money or lost it. It's also why so much of this business passes between generations instead of being bought fresh. Land purchased decades ago at a fraction of today's price becomes the inheritance that lets a grandchild start an established operation without first assembling $20 million from nothing. The easiest way into any of these three tiers, more often than not, is inheriting a piece of the one before it. Which brings us back to the question we opened with. It was never really about how many acres to plant. It was about how much fixed cost you could carry through one bad year without the bank deciding you don't get a second one. The starter operation survives by staying lean and renting instead of owning. The established operator survives by matching debt to a season they can absorb, not the best season they've ever had. The scaled operation survives by using storage, diversification, and purchasing power to soften what smaller operators simply have to eat. At every scale, the operators who build real, lasting wealth in this industry are rarely the ones chasing the highest yield in the county. They're the ones who sized their risk to survive the worst year they could reasonably imagine, and let patient, unglamorous discipline, not a great harvest, be the thing that made them rich. That's the real economics of owning a crop farm. Picture that truck again, bouncing down the same dirt road, the same golden light over the fields, the same combine cutting the last row as the sun goes down. It's still a beautiful picture. It just isn't the whole one, because underneath every frame of it sits a lender, a fixed cost that never cared what the weather did. And more often than not, $20 million of land quietly doing more of the real work than the crop ever will. That's exactly the kind of breakdown we bring you every week. If you want to know what business ownership really costs before you sign anything, subscribe. We're not slowing down.